Good morning and welcome to the 14th Marine Money Conference. It's great to be back here. Thank you, Kevin and Andrew, for this opportunity. A lot of familiar faces, but for those we are meeting for the first time, I'm Parash, Jain. I'm Head of Transport Research at HSBC. I'm based in Hong Kong, and I bring a second Mr. Lam's view. It's a Hong Kong for us and our family. We've been here for last 15 years, and it's delighted to joining this conference yet again. I've been given about 20 odd minutes. I know we're a few minutes late. I'll try to wrap it up in about 15 minutes or so, and probably I'm not sure if there will be any time for question and answer. But as the title suggests, diverging fortunes, and which means that I'll be touching upon our view on some of the subsectors. But to start with, if I can just touch upon the economy outlook. I'm not an economist, but these are the views of our HSBC macro team, which we pretty much try to incorporate during our analysis. And as you see on the left-hand side chart, I mean, it should not surprise any of us. The global GDP growth is slowing down. It will probably come down from 3.1% last year to 2.3% this year. And as it is very, very evident from the chart, it pretty much will be driven by the recovery in China's GDP growth. We are forecasting China to deliver 5.6% GDP growth compared to 1.5% for the US and 2.3% for the world. The chart on the right-hand side tells us that Fed's tightening may potentially peak out in mid-2023, but perhaps the inflation could last a bit longer, and which could not only weigh on the consumer demand, but also the demand for the raw material and commodity. Now on that point, I'll shift over to our views on the shipping. So I'll talk on each of the three subsectors, but what you can see from this chart is that the big debate that we are engaging with our investors, who are the portfolio managers on the asset management companies, is that probably a tanker is cruising along at a high altitude, and there are two views that this is the new normal post-Russia-Ukraine war, and given where the tanker supply is, it can remain higher for longer. But at the same time, shipping being shipping, it has seen cycles over cycles, and as we say, it's a kind of a known unknown. When things are cruising at a higher altitude, something somewhere will come to roll it over. It could be an end of Russia-Ukraine war. It could be a hard recession. When we talk about dry bulk, I mean, pretty much the optimism with respect to the dry bulk sector, apart from the supply, is driven by the fact that it's a China recovery year. And will that be sufficient enough to drive it back to not necessarily 2021, 2022 level, but somewhere higher than where we are today? Or the rest of the world's slowdown in the growth would drag this sector? Finally, moving on to the container, what a fantastic last 2 years it has been for the sector. And now the big debate is that is the industry heading into the losses? Or with the freight rates pretty much approaching back to 2019 level, with some optimism around the demand recovery in the second half, will it find its feet? So these are some of the things that I'll touch upon over the next few slides. So let me start with, or actually, in fact, before I go on to each of the subsector, if there's one chart that you want to take away from today's presentation, is this. I know it's a clumsy chart, but I'll try to explain. When you look at the chart on the left-hand side, this chart was an abstract of the previous boom cycle in 2007-8. And I have deliberately highlighted dry bulk just to illustrate to you what kind of euphoria we were in back then. The red bar here tells you what was the order book back then, and it says that it was around 80-odd%. And essentially, your order book reflects two things: your expectation of the demand growth and your expectation of replacement of the vessels. When we took at what was the kind of 5-year rolling forward average demand and average scrapping was back then, it tells us that industry would have taken 10 years to digest that capacity. Fast forward, we have the global financial crisis, and we have seen a kind of a lost decade for shipping with bouts of recovery. Now, fast forward, if we bring this to today, and then probably you can always see that when it comes to the container, lot of the vessels ordered in the last 2 years means that the demand and supply balance for the container is back to what it was during the heydays. Doesn't bode well, all else being equal. But when you look at the other 2 or 3 sectors, dry bulk, crude, and product tanker, what it tells you is that your current order book is not good enough even to cover 2 years of normal demand and scrapping. And that pretty much gives us the impression that if you are an investor, probably on the R side, whose horizon runs over a quarter rather than the lifetime of the vessels, you buy every decline. And on the container, perhaps you want to sell every rally. Now I'll quickly jump on to each of the subsectors, and now let me quickly dive down onto the container. And 2023 is now often being connected to that, can this down cycle be worse than the previous down cycle? When we look at the numbers, it was 2016, which was the worst year in terms of the numbers for the container sector. And when you look at each of the drivers, whether it's an order book, whether it's a delivery, scrapping, growth, it seems like 2023 is starting on a tougher ground compared to 2016. So, all else being equal, can it be worse than 2016? Theoretically, yes. We are modeling 2023 to be a profitable year, but that pretty much comes from the fact that you have still a tailwind from last year's of contract that will save you through the first 4 months of the year. Just staying on this before I move on to the next subsectors, some of the data points, right? Whether you look at the NRF data, whether you look at the PMI data, whether you look at the inventory data, everything points towards the fact that this is pretty much the trough. And what our view is that if you're looking at an absolute low point in terms of the global demand, it perhaps would be February. If you're looking at on a quarterly basis, it probably will be the first quarter of 2023. And a lot of the retailers that we spoke to are of the view that the ongoing inventory correction will be done and dusted by about May. And we still see that probably sequentially things will improve. But whether we will see a V-shaped recovery, U-shaped recovery, or L-shaped recovery will depend upon consumer sentiment going into the peak season. A couple of weeks back, there was a heightened optimism, but with the turmoil in the banking industry, now again there is a view forming that your peak season may not be as peak as you would like it to be. And the chart here shows about the inventory correction cycle that we touched upon. This is pretty much the NRF data that I was referring to, and it tells us that it's pretty much troughing around as we speak. The first quarter of 2023 could be actually worse than the first quarter of 2019. However, going into the second quarter and the rest of the year, it probably will be cruise along 2019 level. Moving into the dry bulk, and I'm aware that there will be a dry bulk panel session shortly after me, so probably I won't spend much of the time, but very briefly, as you say, right, this is a typical demand and supply chart, which tells you that the supply growth is coming down, demand is perhaps picking up from 2022 level, and it's difficult to say where it will eventually land, but the trajectory is very, very clear. On this, probably one of the points that I wanted to touch upon is that whenever we talk about dry bulk, we pretty much ended up talking about China. And some of the data points that we are keeping an eye on is the bond issuance, is the excavator sales, is it the housing sales. And these are pointing towards some sort of recovery, but you can see from all of these charts that recovery at best is sort of at nascent stage or at fragile stage. When we look back into the different commodities, And China's import accounts for nearly a third of global seaborne trade. But you can look at it that China's importance increases when we talk about the major bulk versus the minor bulk. And why everybody says that when you talk about dry bulk, it is all about China, is pretty much depicted on the chart on your right, where China pretty much is taking the metal when it comes to the dry bulk trade. There are a few more slides, probably in the interest of time, and the fact that we'll have a session, I'll probably skip it. But I think this presentation, Andrew would be able to share if any of you are interested at. And then let me quickly move on to the tanker shipping. It's pretty much the brightest spot for now. And yeah. So what we are seeing now is that the China reopening is driving the crude import, and the full-blown impact of the disruptions from the Russia and Ukraine is in play. We have seen that playing out for the crude. It probably will playing out now for the product tanker. But structurally speaking, we are more positive on the product tanker because of the refinery dislocations. And this is the trend that has begun about 10 odd years back. And now we are seeing that more and more refining capacity is coming up in Middle East, India and China, whereas the refining capacity is flat or declined in Europe, Russia, and to an extent in the US. And the chart below is very, very interesting, because what is important to understand is that 2023 perhaps is the first year where China's oil demand in the fourth quarter will see the biggest jump compared to the first quarter. It's over about 3 million barrels per day or so, and large part of that is, of course, driven by it's the first full year of recovery, but the fact that the international airline capacity is started at 5% of 2019 level in January, and we probably may end at around 70% by the end of this year. This is a chart that we borrowed it from one of the listed company, Tom, and what it's trying to reflect is that the trade recalibration or the sanction on Russia would be contributing 7% of the ton-mile growth. And on the supply side, probably some of the fleets leaving the market would mean that your demand will continue to exceed the supply growth, and which is very, very visible on the next chart, where I talked about the refinery relocation, and you would see that Middle East is seeing a double-digit increase in the refining capacity, whereas Europe and North America are lagging behind. This is the order book that is even tighter than what we have seen in the dry bulk space, and that's where probably a lot of euphoria among the investors and the analysts that we are speaking with. Next, if you look at the order book, essentially your order book reflects demand and scrapping. Last decade it was all about the demand growth and some support from the scrapping. Probably as we go into the next decade, the table will turn, and the scrapping of older vessels perhaps be the lead driver of your order book. And you can see it that a lot of those vessels, particularly on the crude side, 21% of the Panamax vessels are older than now 20 years. And that means that any sharp decline in the freight rates, and you will see that some of these vessels will make its way, and that will help market to find the ground right away. So now I wanted to touch upon shipbuilding briefly, because at the end of the day it's all about demand and supply. Supply, perhaps you have slightly greater visibility. Demand is what demand does. So what is important to understand, and why we are generally constructive on this in the shipping space, is that if you look at the asset prices today, when we look at the new build prices, it's nothing but the cost of commodity and your labor cost, and that has literally gone up from pre-COVID level. And it's, even if you look at the chart on the left and right hand side, they are pretty much settling at around 30% higher than 2019 level. And which means that if you're a ship owner, if you're a ship operator, you probably will try to look for a good deal on the second-hand vessel market before you go and try to look in the new build market. But what is more important is that This time around, bulk of the orders that the yards have either were from the LNG market and then by the container market. Bulk and tanker hasn't participated in this rally. Despite that, most of the shipyards are full for 23-24, probably more than half of 25 book is full, and that pretty much tells you about the pain that the yard industry has also taken in the last 15 years, with the number of active yards are down by about 3/5. And that pretty much drives the optimism that the demand and supply will likely to remain tight. In the last 2 or 3 minutes that I have, I'll just touch upon decarbonization. It's the theme that's now making an entrance into the boardroom discussions. We have this session at most of our dialogue with the investors, and pretty much the focus is zero down on the policy response, on the infrastructure side, and on the innovation side. To many of the corporates that we talk to, they think that it's the policy who need to make the first move, because the last thing that ship owner would want is that it becomes a non-level playing field. Unless there is a carbon tax on it, or unless the future fuels become affordable, it probably will put them into a disadvantageous position versus the one that are not following it. But at this point of time, this time around, not only the regulators, the push is also coming from the consumers or the customers, and there is a general understanding that it will be the container shipping industry which will take the lead, because they are big, it's slightly more consolidated, and the fact that their customers, primarily are part of the S&P 500, are making pledges towards a carbon neutral world. And so finally, in terms of the fuel of the future, there is no one solution, and increasingly it seems like it's methanol, ammonia, and some sort of synthetic LNG will make the cut. But time will tell, none of those are enough to serve the entire market. We have seen that some of the European majors, particularly Maersk, is moving towards the methanol way. We have seen some of the other shipping lines are choosing an LNG way, whereas some of the Japanese ship owners are choosing an ammonia way. And it will be an exciting time, at least for the ship owners who can have the view over a decade or two. And on this point, I'll bring my presentation to an end, and I'll pass it on to Andrew. And I'm not sure if you have time to take any questions.
Anyone have any questions?
Thank you, Parash. It's always interesting to know your views. I have one question, quick one on dry bulk. There are a lot of optimism from China reopening, a lot of optimism from lower order book. When you look at the unknown and unknown, what is the one unknown which can derail the prospect of dry bulk shipping?
Yeah, I mean, it's not necessarily unknown, but it's a known unknown is the protectionism. Because when we look at the grain, right, and India is a classic example, despite being the record wheat production, when they start to get the sense that the next crop will not be as good as it was in the last, they started to put a lot of those protectionism measures in place. And another known unknown or unknown unknown would be is that will the world revert back to business as usual with Russia when the Russia-Ukraine war ends? And those would be, because a lot of those ton-mile arguments will unwind. And the third one would be is that will all of those EEXI or the CII measures that's announced by the IMO, how impactful will they be in the near term? Thank you.